This conference will now be recorded.
Okay, let's get ready. So, before we begin, we must provide a disclaimer that the following information provided is not investment advice. Our methods, teachings, and content are for educational purposes only. All materials and lessons are protected assets of Market Making Strategies LLC. With that being said, welcome everyone. This would be our second options class. And just to give you an idea from a follow on from our first options class, the way that we're going to be doing this is we're going to be doing 8 to 10 parts of me teaching how my strategy works. The entire strategy in depth, based upon prints and everything that we need to do around it. Just to give you, on a side note, I am under the weather, so if I do have to for a second pause or mute myself just to cough, please just bear with me. I will be, hopefully that doesn't happen, but in case it does. So going back to this, it will be 8 to 10 parts once a week. I will break down exactly how I do my options and explain it to the T. After that, it will be only real-time case studies. So it will be looking at prints, creating plays, and then on a weekly basis, we will be talking about the plays that we are in, the extension of the prints of those plays, new price targets, anything that's changed that we must now take into consideration. So the options course and the options side of market making strategies is live, it's ongoing. So if today we created a play and we created a play based off a certain amount of prints, those would have the expectations of that price target. But as we know, every single day, new information is provided in stocks. New buying, new volume, new price targets, or you can have situations where everything is working smoothly and then something happens and changes the direction or the situation for the stock. If you remember, for weeks I kept speaking, even above 15, that HIMS had loads and loads of buying, 20, loads and loads of buying. That stock ended up running all the way to 30. And that was a price target for my position in options that I had in HIMS. Now, when it went to 30, and I remember this, the buying at 30 was somewhere in the range of 3 to 5 million shares were purchased on a given day. It was a day of acquiring at 30. Now, if you just look at 3 million shares on its own purchased on a stock that's worth $30, that right there is $90 million. Someone has placed $90 million right there. Now, who remembers what happened the very next day? News came out. Who remembers what that news was? This was only some weeks back. It was very, very near. Can anybody remember what that news was and wants to type it in the chat? If not, I'll remind everybody. Does anyone remember what news came out against HIMS just weeks ago and the very next day after great earnings and after $90 million plus placed at 30? And Kevin, absolutely. Amazon announced they were a competitor and entering the market. We know they have a pharmacy division, but now they're saying they're going to be going in for GLP-1 weight loss drugs and so forth. Interesting enough, I own med spas and wellness centers, so I know exactly about that space. I know everything about the semaglutide, tirzepatides, Ozempics, you name it, Manjaros. I know everything about it. So it's a space that I'm very familiar with. Now, just based on that news, it went from $30 all the way down to 20 in a matter of a day or two. Yes, it came all the way back, but it goes to show that even once you've seen all the buying, you have to continuously update yourself and be familiar and watch how that stock is progressing on a daily basis because the information can change at any time. Now, typically, what we will see, even if the information changes, it has to be a drastic thing like what Amazon is coming out with because market makers, knowing that they control the stock, control the direction of movement, will still, if you've ever paid attention to some of your positions that you're swinging, Sometimes news has come out, but the news has come out after they meet their near-term targets. They know what's coming out. They know what the situation is. You don't think market makers knew that Amazon was going to make an announcement that they're a competitor even after placing all those shares at 30? Let me ask you, just type in here. Who thinks that the people that need to know, even the ones that bought 90 million shares in HIMS, there's a good chance that they knew that Amazon at any point could come in and announce they're a competitor? Who believes that that could be a chance? I'm not saying that's true, but I'm saying there's a good chance. Who believes that there's a chance that they did? Absolutely. I mean, the man who can place, or the woman who can place, or the company or institution who can place 90 million plus. Now, I said 3 to 5 million shares. That could be over $100 million. So obviously they knew. Now, going upon that, and let's stay here for a second because this is a very interesting case study. What do you think, now that you guys have been in our room for a few months, if you knew that Amazon was going to enter as a competitor, as an institution who placed $100 million at $30 in HIMS, and you knew this would mean that the market would fear it, and all the weak hands and all the retail and those who are scared of the presence of Amazon would drop that stock to 20, what do you think the man at 30 was doing, knowing that the stock has since climbed back and hit 35? What do you think the person at 30 that placed $100 million was doing? Absolutely, Kevin. They were acquiring for cheaper. And let me ask you, Kevin, let's do some basic math. If I bought a million shares, and I'm going to make this simple, a million shares at 30, that's $30 million. And I knew that Amazon was going to be at some point announcing that they're going to be competing. And now it comes all the way down to 20. And I've averaged down and I've been buying at, let's just say 20. Let's make life easier. They bought another million shares at 20. What's their average now? And they own double the shares. What's their average? Their average is 25. If we look at basic math, if they averaged at 25 and they own 2 million shares and they decided, you know what, we're going to sell it. Our target was 35. What we showed the 30. So the 30 buying was more than enough and it's long term for 50. But for simple math purposes, Kevin, if when it went to 35, they sold their 2 million shares, how much profit did they make? Give me the number. If you have an average at 25 and you sold at 35 and you got 2 million shares, absolutely. Thank you. 20 million profit. Let me ask you guys, in a matter of a month or less, would any of you be mad going to your hedge fund boss and saying, do you remember that position you needed me to play? Well, I just sold it in a month for 20 million profit. Do you think anyone would be mad at you? And we know they didn't do it for $35. The buying at 30 was absolutely enough for it to go to 40 as a first price target, 50 as a second. Why do I say so much so far away? Because the outstanding shares in the stock are so low that you could drive towards that price target and create a market cap that's feasible. Simple as that. So with that being said, let's get into the strategy, but I needed to bring that case study because I thought it was so pertinent to where we are in our classes. Okay, so market making strategies presents option strategy and research, learning each aspect of the strategy. And as our slogan says, through the tape, we learn how the market moves. Can we move on to the next slide, please, Milan? So this is going to be the 7 parts which I will be breaking apart. These are the bridge points of the strategy. The first part is prints. We formulate the play once we've established prints and the impact being short-term, mid-term, or long-term. So for short form, ST, MT, or LT, and I will be going over short-term, mid-term, or long-term once again. I did speak upon that in the last class, but I want to go over it one more time so it's crystal clear for everybody. Number 2, assessing the price target ladder. What does that mean? as we see buying coming into a stock, and whether that's one day or the acquiring over a few days, we start understanding that you got a first target, a second target, and a future target. Because the buying can be so large, and depending on the strategy implemented to acquire, that will either say this is going to reach a quick short term target, is going to have the buying where it's going to have a couple of targets, or it's got so much buying and so much short term and so much long term that we have near term targets that the short term buying needs to reach, and we have the volume that is needed. But we also have these monstrous prints at levels that are more long term. So we will be assessing how we create price target ladders. So how do we create an options or swing play? Now remember, I am talking on options, but you can use whatever instrument is part of your strategy, whether that's taking shares for swings, however you may do it. But ours is based on options. So what we will do is, depending upon the type of acquiring we see, we strategize how the price target ladder is going to look. So we might have options for 3 months out, 6 months out, and a year out in order to take advantage of all those targets. And the further you go out, and if you see it's going to have a price target, so for instance, if HIMS was at 30, it pulled back to 20, we took options knowing that 30 was enough for 50. We know that's not going to happen next week or a month from now. That could be 6 months or a year away, because at the end of the day, if HIMS goes from 30 to 50, it's close enough doubled in value. For a stock for a stock to double in value, what does that mean that it's saying about the company? It's saying that the company is worth double. It has doubled in its valuation. That means that the company had to really show some good milestones, really good earnings, improve revenue. So we know that cannot happen overnight. So for instance, just put it in basic sense. If you own a business that was doing $1 million a year, it's not necessarily going to, or for a very, very high percentage, just suddenly do $2 million a year within a month or two. It takes time for it to improve those numbers. So in the same respect, we use a bit of common sense and say, if we know there's enough buying for it to go up that much, we know it can't just happen overnight. It's going to take time. So in a position like HIMS, you'll say, well, the 20 needs to get back to 30 quickly because we know there's huge buying established there. That could easily be a short-term target, knowing that the pullback from 30 went down $10. Now, if you say to yourself, 30 for the long term has 50, but easily near term, 4 months, it should get to 40, just given the amount of buying, the earnings, the positions that we've seen, that creates where you could put a play of, let's put some options 4 months out, and we're going to do a target price, given that we had a pullback to 20. Now, what that actually allows you that nobody else can do if they don't know Prince is, could you imagine you got into your options on a $10 pullback, knowing that 30 needs to go to at least 40? You're going to be out of the money, which means you are paying far less for your option strike. Because if it was at 30 and the price target was 40, let's just say, you'd be paying a lot more because it's so close to 40. But given that we understand and we trade our options based off prints, that means when it pulls back, that is absolutely money in our pockets. It allows us to not only take options for far cheaper, but we can take far more. And what happens? Typically, what you'll notice when the buying is that strong, and if the volume goes in a valley, which means it requires a pullback in order to build on that position, it will be a lot less time for it just to go back to 30. And for those of you who have already played options and know how options work, if you bought options on a pullback from 30 to 20 and it goes back in no time to 30 where the buying was, you could easily double or triple the premium on your options just off of that. So when I see people in the market and other companies and other people posting a 20, 30% return on their options, I have to be completely honest. It's a bit hilarious to me because I've taken so many positions and options where just off a big pullback from big buying where they're acquiring more, in a short amount of times when it just simply goes back to the buying, I'm already up a couple of 100%. Or at least I remember in DJT on the pullbacks, I remember one position, I was up 78% just on the pullback going back to the buying. So Prince gives you such an advantage that you can already start building a huge return on your investment based on a pullback. How many of you understand what I mean by that? Is that clear what I mean? How the Prince can help us achieve far greater percentage returns just based on the fact that we know what a pullback means on Prince. Whereas if you don't know Prince, you're going to have no clue. You're going to be looking at a chart. Let me ask you all, type this in. We, as those who are basing our options on Prince, will look at a chart and say, we know that it went from 30 to 20 because it's pulling back from humongous buying and building on that position. And we are literally licking our chops because the way we see it is you are giving me an opportunity to get options for far cheaper. If my price target was 40, so I'm going to give you a scenario, and I think you lot will really enjoy this. Let's say we didn't know anything about Prince. Great earnings come out, which they did for hymns. And in those earnings for hymns, it was sitting at 30. And you're like, oh, this is great earnings. And I think this is going to be a price target of 40. And you were smart enough to say, I'm going to take my position 4 months out. And for the strike price of 40, it was $3. I mean, well, let's make it easier. $2 for a price target of 40. Now, that's a options trader who can only know how to base his options off earnings and a chart. We as Prince traders realize that the buying at 30 to a huge percentage would require a major pullback. Now, $10 is monstrous. That would never have happened if it wasn't for Amazon. But let's just use the information provided. When it pulls back to 20 over 2 days, what do you think the chart trading options trader did with his position? Remember, he took it at 30, 4 months out, paid $2 for a strike price of 40. Absolutely. Perfect answer, Trevor. He panic sold. Now, Trevor, you as the options trader who uses Prince, you love the earnings, you listen to the earnings because you're a smart trader and you never allow yourself not to be informed. You also are a great trader because you know how to read Prince. And you had a notation that, okay, this was about 5 million shares at 30, major psych level, major news. Clearly, this company's going in the right direction. I expect this on such gigantic buying to have a pullback. So when it pulled back to 20, Trevor, you opened up your options tools and you saw 4 months out, and I'm talking 2 days later, you saw 4 months out the 30 price target for $2 because you're $10 below. Are you guys all understanding what I'm saying? Just please tell me yes, we're on the same track with you. Perfect. So now Trevor goes and buys the 30 strike 4 months out. What does Trevor already know about his position? What happens above 30? So let's say Trevor has 10 calls, the equivalent of 1,000 shares. What does Trevor start seeing above 30 on his calls? He starts seeing $1 for $1. That means because 30 is the strike that he was able to now achieve because it pulled back $10, Every time it moves $1 above 30, Trevor makes $1 for $1. So the gentleman who panic sold lost $2,000, but let's say he was smart enough and he only lost 50%. So he lost $1,000 because all he knows is charts. Trevor waited and figured that buying was too big and needs a pullback, and then happened to get a nice boost in the pullback building period by the Amazon news. So within a week, Trevor's position, just because it moved all the way back up to 30, his premium is now $4. How much is he up already just by coming back to where the buying was? How much is he up already in a week? Trevor is up 100%. Now let me ask you a question, Trevor. Has the stock even started moving towards your target yet? Now, Trevor, 2 months in, it hits 40. Your options were 4 months out. 2 months in, it hits 40. Now, I told you it's $1 for $1. How much are you up in your options, Trevor? Hard to imagine, but it's that number. How much are you up? If it moved dollar for dollar, $10, you would be up quite literally, and yes, this is not a lie, 1,000%. Apologies. Well, no, yeah, you would because, sorry, 500% you'd be up. And that's simply based off strategizing on prints. Who likes the possibility that on a routine basis, your position, just because you know how to read prints and how to formulate a strategy on option based on prints, that many times you will be up 500%? Does that sound something exciting to any of you? I will remember my biggest percentage gain was 3,800% on Apple. I took over $40 in Apple, and 15 of those dollars that contributed to such a great return was on pullbacks. I love pullbacks. Any of you who know how I trade, I love pullback entries. I absolutely prefer them over money time entries. Because why are pullbacks so great for us? What does that basically mean when you get a really good pullback? That your entry is what? Perfect, Trev. You're getting a better price than the MM. You can't beat that. So that was just a quick, I'm going to keep using HIMS as our study. So then the third part of this strategy will be the 7-point company analysis. So when we do the 7-point company analysis, we are going to do a quick breakdown of the company. I'm not going to go into that into detail, but that's going to be a class of its own. Number 4 will be executing the play in options. So creating the play. Number 5, managing the trader. Sorry, I put trader there, but meant to be managing the trade. Number 6, we analyze the entire trade. We want to break down how well we executed the trade, how well we managed the trade, any lessons to be learned, how we can improve on that. Because at the end of the day, one thing that I think is more important than the trade is the lessons that we learn from it. In general, in life or in trading, you're never going to get better at what you do unless you're learning how to get better from what you did. And that's the same in trading, whether that's a simple day trade or that's a long options trade. You got to break it apart, analyze it. Did you reach the right price targets? Was there factors that you didn't consider correctly? Was there factors that you should have considered more? We always want to improve, and we can't improve unless we have a very strong form or method of analyzing the entire trade. And 7, analyzing the psychology in the trade. That's going to be very interesting. And when we get to that part, market making strategies has a therapist and psychologist as part of our team who's currently really breaking it apart, learning the dissectomy between a trader and psychology and life. So get ready, because in that section, I will be introducing her in our class and in our company. So that's going to be very exciting. On to the next slide, please, Milan. So today we're going to be breaking apart prints. This is our first part that we're going to be talking about. So prints, understanding the print strategy is vital so you are able to plan how to strategize your options play. Options require you to be resourceful with limited time and diligent with management at price targets. So what does that mean? The one thing you know when you use options as your tool or instrument for trading is that options have time decay. So we must make decisions quick. How many of you have took options, it hasn't quite got near where you expected it to go, and maybe that didn't mean price target, but maybe that meant how much money you wanted to make, and then it quickly dissipated, it quickly pulled back, the volume killed off, and now it never went back there again, and you ended up taking a very small profit or a loss. How many of you have been there? Because I know I have. I know I've seen some ridiculous returns possibilities, expected it to go back, but forgot that I needed to keep a better eye on my time decay. How many of you have been there in your options? Trevor? Yeah, definitely. That's why we must remain diligent with management at price targets. And I'm going to explain to you next time, in a bit, what that means. Why do we remain diligent at price targets when we are doing options using prints? Why is that important? Why do you think it's important that we must remain diligent in our options when we are following prints? Time is ticking, true, Millen. But let's just keep it real simple. When the big positions are taken, are they necessarily always worried about getting a dollar, two, or more about the future? Or have they got so much money on the line? And number two, you got to understand, for them to meet their targets, are they hoping retail or somebody else takes over and takes them to their target? Or do they have to control the stock to their target? Which one do you think it is? They have to control the stock. I mean, imagine this. You guys, as day traders, options traders, how many times have you seen it touch the target and just literally not go back for weeks and months? Like literally just trade itself, it opens one day, it hits target and it doesn't go back. It happens all the time. It happens all the time. So what do you think? Who do you think is making that happen? That's the market maker completing their play, completing their short-term move. So if you're following prints, you better follow when they exit as well. It's in my option strategy, the hardest thing for people to do, or will be to do as you learn my strategy, is when you start seeing some of these returns, what's the word that comes in very quickly, even if you're up 300%, 200%, sometimes 800%. What do we get very quickly, even though in the real world 10% return on your money annually is considered great. Yet, in a matter of months, when your return is above hundreds of percentage, and let's make it simple, you're up 300%, 30 times what you'd be happy with in the real world. Yet, what always creeps in without fail? It starts with G. Thank you. Greed. If I could advise you to do one thing and put one sticky note on your computer Greed equals failure. If there was a definition in the dictionary for greed, it should equal failure. You're a failure in your analysis, your strategy, you're a failure as a businessman, you're a failure in everything. Greed has never executed success. Do we agree with that? So if you want to be a consistently extremely successful swing or options trader, never forget who took you to those huge gains, the market maker. You had no hand in that at all. Your greatness was you became a great follower of Prince. So if you're a great follower of Prince and you truly trust who you're following, what must you do when they meet their targets? You must manage. Perfect, Millen. What I love about what Millen just said was manage. Why do I love what you just said, manage, and not something else, Millen? What did I not tell you need to do? Thank you. Well done. Brilliant, Millen. You don't need to get 100% out. But what do I always tell you? You reach a target, you got to manage your position. If you're up, this is the rule of thumb. If you are ever up 300%, what is my rule of thumb? I do not care where it is in the stock. What's the rule of thumb if you're up 300%? I do not care. Whatever happens, I don't care if you're $3 away from the price target. I don't care. I want 50% off always. Now, if I had $1,000 on the line as an investment, I'm up 300%. How much am I selling it for? No, if I'm up 300% and I had $1,000 investment, that's times three. I'm selling it for $3,000, 300%. Okay. So if you divide that and you sold 50% of it, you're at 1,500. So you're spot on. Sorry, Trevor. Spot on 1,500. So now what is your 100%? What is your return? Sorry, Millen's got it perfectly there, Trevor. I apologize, gentlemen. But you're spot on. If your total position was up 300%, that means your total profit is at that moment 3,000. If you sold 50%, like I say is rule of thumb, then you've accepted a complete profit of 1,500. That means no matter what happens, that position goes down as a 50% profit. That also now allows you to manage the other 50%. Because remember what I said, imagine you were $3 away from your price target. Now, is that a successful approach to being a consistent options trader? Yes or no? Now, if you look in front of you, Millen, is there any way we could make that just a little bit bigger, possibly, so they can? I'm not sure if it's clear enough. The Yeah, possible, and we can go through it. Even you can slide it to. Is that the whole thing there, Millen? It seems like it. Yeah, yeah, perfect. Okay, could you start on the left side, please? Okay, so this is a quick tool that I created, and we can share this Excel file once we've completed the courses and so forth. But if you look on the left-hand side, we got the date. Then we've got the prints. So this is an actual case study from DJT. This is the one that we took. This is the one that I purchased options back in early September, I believe, for $1.85, and I sold at the end of October for 18.75, 75% of my position. And if you look at this, the prints 15 to 20 multiple buying. What does that mean? It kept going to the $15 level and the $20 level in a consolidation, and they kept buying in spurts at each of those controlling print levels. The volume was increasing on the daily. What does the volume increasing on the daily technically mean about that stock? My day traders should be answering this straight away. Thank you, Milan. Interest is increasing. Increased interest. That's right, Trevor. Perfect. So, we've got more interest. Now, what did we know, which was the unique information about DJT in the month of September? What did we know that was the unique information that we could 100% use in our favor as to why this is all happening? Who was running for president? The elections. And we know one thing. Does that go hand in hand? Absolutely. One thing we know about Mr. Trump is he's a businessman. So if he's a businessman and you're a businessman and you are finance, he might be the certain person that you want. He's a catalyst. Perfect, Austin. Austin, perfect. So when we looked at that, we already had some unique information. We also knew that this play could materialize in the month of September because the elections would be early October. So if you look at the comments, build console between 15 and 20 was huge. The volume was consistent and increasing on the daily, and it was a vote month. So what is our strategy for this play? Short term and mid term, because we know that most likely it would meet all its targets and the huge position or part of that play would all occur in September while the iron was hot. Market makers can take the most advantage when they have the most what? Interest from retail. When the eyes are on a particular stock and everybody wants to play it with whatever they have, that is what they need. The more interest means the more volume, means the more amount of money they can make, which means they would increase the range of possibilities. At the end of the day, if I have half a tank of petrol in my car, it would take me halfway to Orlando from Miami. But if I have a full tank, I can go to Orlando in past. It's the same way in stocks. The more interest, the more participation they get from retail, the more help they get from other institutions and market makers, that will help them prolong and increase the range and price targets. They can technically, in the end, do what? Make more money. That's what it's about, making more money. The reason we love to follow market makers, the reason we love prints is what is their job to do and what can they do that none of us can do? They can make money and they can control stocks and they can play the bid and ask. That's why they are the perfect person to follow. So when we look at that, now we see our first price target for the buying between 15 and 20 was 30. 4 months was a time frame. Why did I want? If they don't make money, they don't have a job very long. Exactly, David. So if the reason we wanted to have a short term and a midterm play for this was one, the buying was exceptional and easily had the buying for 50 just from what I saw at 15 and 20. But we also realized there's two things can happen here. There'll be a huge move within that month of September being elections. And if Trump was to win, there's a great chance it could continue on. And the buying agreed. The prince agreed with it. Do we create short-term, mid-term plays if the prince are not agreeing? Yes or no? Do we do anything if we have categorized ourselves as followers on prince if the prince do not agree? And lastly, if the prints agree but the volume is waning off on the daily, do we now look at it as short term, or do we have to realize it could take longer and go to midterm or long term? Exactly. See, the time frame, yes, the size and the quality of the prints and then buying up price levels is important. But if you don't have the sustainability of volume, it's going to increase the time it takes or extend the time that it takes for them to meet their targets. So for this particular position, as you see, we had the short-term and mid-term buying volume. First price target was 30, and we got 4 months out. Now, if you look at the line right below, that's management. That's where you're going to write what you took off. So if you notice for this, percent manage at the first price target, 50%. The second price target, I would do 40%. Now, the second price target is not written there, but I'm just using this as an example. If you look at below that, between October 10th, and this is correct, by the way, and October 24th, 12 separate times. I even remember writing it in our room, I believe, that 30 was hit 12 times. So imagine this. You've had nothing but acquiring, exceptional acquiring. And what does that mean for those of you who are novice? When they are buying at levels, and when we say levels, we mean $1, $2, $5, $8, $9, $11, $12. Those are whole numbers. Those are levels. We also call them controlling levels. But if they're buying non-stop up 15, 16, 17, 18, 19, 20, 21, 22, they're also telling you that the valuation of this company has just improved, has increased. We don't see less than this. Hence, they're buying up everything going long. So now you got 15 to 20, and then they come in and they buy 12 different times at 30. And I can tell you it was never less than 500,000 shares. So if it was 1,000,000 shares, let's just make it easier, and they bought 1,000,000 shares on 12 separate occasions at 30, how many shares did they buy at 30 overall? Just at 30. I'm not talking about all the building below and the acquiring below that they did on 30, but just at 30 alone, how much? So if 12 million shares, Milan, at 30 are purchased, could you tell me what is the valuation of that position? 360 million. Milan, do you think someone who has the ability to buy $360 million worth of shares and everything that they must have been acquiring below it expect to make $1 or $5 on their trade? Is that why they did all that? Is it even feasible that they're happy with $10? That they're going to walk away with 36 million in profit? Is that really even feasible? Of course it's feasible, but their risk to reward has to make sense. Brilliant. You put it in there before I said it. You're learning well. The reality is, if you have the ability to buy $360 million worth of shares, you have the account that can move it to 50, a great psychological level, a great return, and that's showing you what is that kind of telling you about the short-term forecast of interest and volume that they expect. What is that telling you about the short-term interest and volume that they expect when they place that much money at 30? It's going to increase. It's only going to improve. And that's going to improve as we get closer to the elections. And that's exactly what happened. So if you look at it, the volume was in a holding pattern, which means it was high volume, consistent. It was sustaining, very hard to do, but makes sense in this particular situation. This type of huge buying added onto the early alignment improves the range. Strategy. Short-term buy due to the increase in range from the prior buying starting out below 40. Our first price target is 40. Our second price target is 50. We're going to place a 2-month and a 4-month based on unique correlation to vote month. Do you all see how that strategy worked and how I created that play based on the micro, macro, and exterior factors on this stock? We see that? Perfect. So what we're going to quickly do, we're coming to an end. This was supposed to be a 30-minute spot. For those of you who know me, I won't stop until I get all my information across that I need you all to know. So it's typically going to be longer than expected, but that's fine. What I want to do quickly, Milan, let's go through short-term, mid-term, and long-term slides. Let's just refresh everybody quickly. It'll be a real quick few minutes. Can we go to the next one, please? Short-term prints. How do we know if the build is short-term? When the acquiring or position is small, when they are moving to targets within the day, with a range still available, relative short-term buying, in between controlling prints, no intraday consolidation. The last part that's not on there is the volume has to be higher. So if you look at OKLO in that short-term part of their overall move, do you notice how the daily volume is exponentially higher? Because the short term means they want to get it to a certain price point in the short term before they do a huge consolidation where volume will wane and they go for their overall price target. Do you guys see that difference there? Perfect. Now, Milan, can we go into the midterm, please? So midterm now means you've got that kind of sustained volume. So building at levels, acquiring occurs at more than one interval. So now we want to see a larger position being built. A larger position is going to require more time, but it's also going to have a higher extended range and target. The position not only shows a near-term target, but a secondary opportunity because of the size of the build. You're going to see positions that are taken for the bit longer term and higher target, but you're also going to see short-term market makers coming in and saying we're going to take advantage of some more short-term targets. Multiple people can have different strategies within that consolidation. The third part, the risk placed by the MM is too great for small gains. Very similar to what we saw in DJT. Acquiring over a few days within a consolidation. You want to see extension of acquiring, building a larger position. The volume is consistently high, but it can go into a valley also because the duration is going to be longer. But you don't want it to be in one of those valleys that keeps waning and lowering, but just lowers in volume for a shorter amount of time to build. Movement from buying occurs quicker. And the last one, Milan, please, on the long term. Lastly, how do we know if the prints are longer term? Acquiring occurs for days. The volume is lower, and all they are doing is building a position for the long term growth of the company. The prints are controlling levels are far too big for short term or mid term. Millions of shares purchase specific levels, but not just at specific levels, but you're going to see lots of shares acquired, but the volume is lower. That means that it's in a complete build stage. Or sometimes you see just a huge position taken one time, but nothing around it, no other acquiring, no real strategy. Then you know those prints are very long term because there's only one person in agreement on that stock. For you to create short term and mid term, you want to see multiple alignment agreeing, multiple high volume on the daily. That's what's going to take it to its targets quicker. If the volume is not there, but they're still buying a lot, that's telling you it's a long term target. It's going to take them longer to get there, and that's the strategy they're using. So, with that being said, we are at the end of class 2. I hope you all enjoyed. If you have any questions, I'll keep it open for 5 more minutes. Raise your hand and please feel free. I'll give you guys a couple of minutes if you have any questions. If not, and remember, this will be posted. You guys can all revisit this and watch it again. Millen will put it out an announcement exactly where we're going to be. But I don't see any more questions. Hope you guys really enjoyed that class. I know I love teaching this one. Looking forward to all the next parts of the series. Have
There's
a
one question, Doug.
afternoon. Okay, go for it.
From Trevor. He said any long-term examples, PLTR.
Yeah, absolutely, Trevor. PLTR is absolutely a great long-term example. I'll tell you some more long-term examples. SOUN, soon. Huge volume, huge buying, but the size of the acquiring is somebody building monster position for the longer term. Selfie, another great long-term opportunity. But both Soon and Selfie, with the amount of volume and interest it's had weekly and daily, has also made itself available for a really fun short-term and mid-term targets. And then you've got a few more long-term, but we can keep going into examples. We don't want to do that too much. Let's stick to understanding how the strategy works first, okay? With that being said, hope you all have a wonderful afternoon. Our time is up. Hope you enjoyed. Please watch it again. If you've got anybody that likes options and you think might enjoy my strategy, please feel free to send them a link and tell them to join. Thank you and have a lovely afternoon.